Welcome to The Money Maze, the podcast for South African retail investors who want to stop feeling like they're drowning in jargon and start navigating the market like someone who actually knows what they're doing. I'm your host Jay, your compass in a world of fine print footnotes and fees so hidden they might as well be in Morse code. In today's episode is for the passive investors, the crowd that wants to grow wealth without getting ulcers over stock charts. We're going to decode three essential terms that show up everywhere when you research index funds and long-term investing. By the end of this episode, you'll understand exactly what you're buying, how it's priced, and how fees quietly nibble away at your returns. So let's dive in. You've decided to go passive. Great. Now you're faced with two oddly similar vehicles, the ETF and the unit trust. They both promise diversification, market exposure, and long-term growth. But what are they really? ETF or exchange-traded fund is a bundle of assets, usually shares or bonds, packaged together and listed on the stock exchange. You buy and sell ETFs the same way you would buy or sell a company share, during market hours at a live market price. Unit trusts, on the other hand, are pooled investment funds where your money is combined with that of other investors and managed by a fund manager. Unlike ETFs, unit trusts are not traded on the stock exchange. You buy units directly from the fund manager at a price calculated at the end of the trading day. Now, why does this matter? Well, let's look at liquidity. ETFs offer intraday trading. You can buy and sell anytime during the day. Unit trusts, well, you've got one price per day. If the market tanks at 10 a.m. and you want out, tough luck, buddy. You're getting the end of day price. Pricing transparency. ETFs show you live prices and order books. Unit trusts only show NAV. More on NAV in a moment. Costs, well, ETFs are generally cheaper because they're not actively managed. There's no sales commission, no advisory trail fees, and minimal admin. Unit trusts, well, you might be paying for a team of analysts you didn't ask for. Minimum investments. Unit trusts sometimes allow very low debit orders. ETFs usually require a brokerage account. Though fractional investing is helping that shift. Still with me? Great. Because now we get into something both ETFs and unit trusts rely on, but they calculate it differently. NAV stands for net asset value. It sounds like a term reserved for accountants, but trust me, this one matters. NAV is the per unit value of the fund's holdings. For example, if the fund owns 10 million rand in assets and has issued 1 million units, then the NAV is 10 rand per unit. In unit trusts, NAV is the price. Whatever the fund calculates as NAV after market close, that's what you pay to buy in or what you get if you sell. In ETFs, things get spicy. While the NAV still exists and gets published daily, you trade ETFs on the open market. That means supply and demand can push the price above or below NAV. The difference is known as a premium if you pay more than NAV, or a discount if you're buying for less than NAV. Now, why would someone pay more than what the fund is technically worth? Sometimes it's optimism, sometimes it's demand, and sometimes it's just inefficiency. But it's crucial to know the market price and NAV are not always the same. The key takeaway: NAV tells you what the fund is actually worth per unit. Market price tells you what other people are willing to pay for it. Understanding both can help you avoid overpaying. Now let's look at TER, the silent wealth eater. TER stands for total expense ratio. It's one of the most underappreciated metrics by new investors. TER is expressed as a percentage and represents the annual cost of running the fund, deducted from your investment automatically. This includes fund manager salaries, admin costs, trustee fees, and even licensing for using an index. A TER of 0.4% means 4 Rand out of every 1,000 Rand you invest is used to pay the fund's operational costs each year. It might sound small, but over time those fees compound. Let's say you invest 100,000 in a fund with a TER of 1% and another with a TER of 0.2%. That 0.8% difference might not feel like much now, but over 20 years it could mean tens of thousands in lost returns. So here's the key. Even in passive funds, costs matter. You don't need to pay 2% for someone to track an index. A robot can do that just fine. One more thing, TER is not the same as total investment costs. TIC includes even more fees like platform charges and brokerage. But we'll cover TIC properly in a later episode. For now, let's just know. Lower TER, more of your money actually working for you. Now, a bit of a bonus mini segment on other hidden fees that's standing in the shadows. While TER is important, it's not always the full picture. You may also encounter performance fees. Some actively managed unit trusts charge extra if the fund beats a benchmark. Sounds fair, but it can be gamed. Trading costs, it's inside the fund. Every time shares are bought or sold, there's a cost. Some funds trade more than others. Wrap fees, if you're investing through a third-party platform, they might tack on a flat monthly fee or percentage. Bid-offer spread, especially in ETFs, the difference between the buy and sell price can become a hidden cost. We'll unpack some of these in future episodes, but the moral of the story is this. The less you understand about fees, the more likely you are to be overpaying. So let's do a recap of your Stokvel starter pack for this stock lingo on volume 8. ETF versus unit trust. ETF trades like shares with live pricing and lower fees. Unit trust offer end-of-day pricing and may come with more admin and advisor costs. NAV, net asset value, is the real value per unit. In unit trust, it's the only price. In ETFs, it's just a reference. Market forces take over from there. Premium and discounts, ETFs can trade above or below the NAV. Don't assume the price reflects exact value. Always check both. TER, or total expense ratio, a percentage fee that's deducted from your fund every year. Even a small difference can compound into big costs. Know your costs. Performance fees, wrap fees, trading fees, they all add up. Don't be the investor who only finds out after retirement that fees ate half your gains. So that's it for this episode. Next time someone says passive investing is set and forget, you can raise an eyebrow and say, sure, what's the TER? And how far off NAV is this ETF trading? Thanks for tuning in to this episode of The Money Maze. If you feel like you've leveled up your investor lingo today, give it a share. Someone in your circle probably investing blindly, paying TER like it's a tip jar. I'm Jay, and this has been your passive investing decoder for the week. And remember, this podcast is for education purposes only. It's not financial advice. Please speak to someone with a license. See you in the next one. Cheers.